You finally saved up a massive deposit. You did everything right, played by the rules, and got ready to buy. But while you were sleeping, the global property market fundamentally fractured. I'm the director of Universal News Frontier, and welcome to This Explainer. We are no longer in a post-pandemic recovery. We've entered a brutal, entirely new era defined by extreme limits on what you are legally allowed to do with your own money.
Okay, so here's the terrifying reality of early 2026. Even if you scrape together that massive $100,000 deposit, the banks just slashed the average couple's borrowing power by over 73 grand in just 4 months. Seriously, think about that. You didn't lose your job, your salary didn't drop a dime, but your ability to actually buy a home was effectively erased by this invisible mechanical force. And hey, if you're thinking, well, I'll just escape by renting, let's take a quick look at the rental market.
In New York City, we're seeing what analysts are calling a mobility trap. Basically, the gap between what long-term tenants currently pay, their contract rent, and the new asking rents on the open market is so massive that it costs over $21,000 a year just to switch apartments. That's a huge penalty. If you wanted to just move across town, you'd need an additional 70 grand in pre-tax annual earnings just to comfortably bridge that gap. People are literally financially trapped in their current living situations. So how on earth did we get here?
Let's look at the bigger picture, the pivot that failed.
Going into this year, the entire world was holding its breath for 2026 to be the year of the pivot. Everyone, from Wall Street traders to the everyday kitchen table budgeter, fully expected interest rates to finally drop and bring us some much-needed financial relief. But that pivot failed. The relief never arrived. Across the board, central banks were forced to keep rates punishingly high or even raise them further, like we saw over in Australia and Japan. And the culprit? Geopolitical volatility. Escalating conflicts in the Middle East closed down critical transit corridors, and that generated a massive energy and commodity shock. The cost of things like fuel and fertilizer surged, which drove inflation right back up. So central banks basically had their hands tied. They had to keep rates elevated to fight that persistent inflation.
And that brings us to a terrifying word for economists, stagflation. Now, I won't bore you with a textbook definition, but in plain English, it means the cost of living keeps accelerating even while economic growth completely stalls out. It is a nightmare scenario. Historically, when interest rates stay high, property prices drop. It's supposed to balance out. But because of these stagflation risks and intense supply shortages, that traditional relationship has completely decoupled. High rates are destroying your borrowing power, absolutely, but property prices aren't crashing to compensate.
Which brings us to what's surprising, the flight to affordability.
Now, this is where it gets really interesting because the market is behaving in a way that feels totally counterintuitive. Mainstream headlines love to focus on national averages, but they're missing what's actually happening on the ground. We are witnessing this massive flight to affordability. Let's use Sydney as a prime global example of this paradox. The expensive, top-tier mansions, they actually saw prices drop by 2.4%. But the bottom-tier, entry-level homes, the ones regular people actually buy, went up by 2.5%. High rates didn't make homes cheaper overall, they just pushed everyone down the price ladder. So now you have first-time buyers, investors, and families who used to look at mid-tier homes, all fiercely fighting over the exact same shrinking pool of cheap houses. It makes the most affordable homes the most aggressively expensive to win.
Let's dig into the mechanics, the real serviceability trap.
This brilliant, albeit painful dynamic leads us to the core issue. We aren't just dealing with a pricing problem anymore. We're dealing with the mechanics of a serviceability trap. This is a brutal limit on what you are legally permitted to borrow from a bank. Just look at how fast your power evaporates. For an average earner, every single rate hike in early 2026 mechanically stripped away between $11,000 and $13,000 from their maximum borrowing limit. Because banks mandate stress testing, meaning they have to test if you could still pay your mortgage if rates suddenly jump to 9% or higher, your buying power falls dramatically faster than any actual dip in house prices. We are seeing buyers finding their pre-approvals expiring, only to be reissued with limits so incredibly low that they're entirely priced out of their own neighborhoods.
And what's supporting these stubbornly high prices globally? The North American structural deficit. In the United States alone, the housing supply gap sits at a staggering 4.03 million homes. We simply aren't building enough roofs to keep up with the population, period. That 4 million home deficit acts like a concrete floor holding prices up. Even with crushing interest rates, values simply cannot collapse when supply is this tightly constrained. And that abstract data point translates into very real, very human consequences. As of 2025, there are 1.82 million missing households in the U.S. alone. These aren't just statistics on a page. They're millennials and Gen Z adults who are trapped living with their parents, with relatives, or cramped into apartments with roommates. They're totally ready to start their independent lives, but they simply cannot afford to enter the market. This massive reservoir of pent-up demand basically guarantees that the moment rates ever do drop, a massive flood of buyers will rush in, which will just further prop up those prices. So, the prediction. Where do we go from here?
So what happens next? Well, if history is any guide, we're looking at a highly fractured future. Here is what I'd expect to see as we navigate the rest of 2026. First, shared equity exhaustion. Government help-to-buy schemes, where the state essentially buys the house with you to lower your deposit, are going to run out of funding fast. Australia's 10,000 place cap, for instance, is on track to be drained in just months. Second, we're definitely going to see breakouts in supply-constrained markets. Finally, the U.S. institutional build-to-rent shift. Now, I know this is heavily politicized right now. President Trump issued an executive order, and the Senate passed bills trying to ban large institutional investors from buying single-family homes. But looking completely impartially at the source data, these institutions only own roughly 1/3 of 1% of the housing stock. The reality is, these large developers might be the only entities out there with the capital capable of actually financing the massive new housing supply we desperately need to fix this deficit.
And to prove that supply dictates absolutely everything right now, just look at Perth, Australia. It's forecasted to see a massive 12.8% price growth this year alone. It literally doesn't matter how high the central banks push interest rates. If a market is fiercely supply constrained and population growth outpaces construction, you will see astonishing localized gains. Make no mistake, supply is the ultimate trump card over interest rates. Which brings us to the community loop, the bank of mom and dad.
This is the final, and perhaps the most profound, shift of 2026. The Bank of Mom and Dad is no longer just a nice little bonus from your parents, it is a major shadow financial institution. With average intergenerational gifts hitting $70,000 in Australia and informal gifts from parents totaling £17 billion annually in the UK, this parental cash injection is very often the only thing separating a successful first-time buyer from someone who is permanently sidelined as a renter for life. So I want to turn this over to you, because right now the data strongly suggests that the benefits of housing wealth are becoming entirely concentrated within specific demographic lines. Has the great dream officially become a hereditary privilege? And if our entire market is now built on the necessity of parental wealth, how do we actually fix it? Jump into the comments and tell me what you think the solution is. Should we be looking at sweeping zoning reforms, wealth taxes, or something else entirely? Let me know your predictions below, and I'll catch you in the next explainer.